Global macro. U.S. reshoring flame lit for $10 trillion opportunity. Christopher Snyder, CFA, equity analyst, Morgan Stanley Company, LC. Following 2 decades of underinvestment and stagnation, we believe the U.S. is in the early innings of reindustrialization. We estimate that this multi-decade opportunity will command more than $10 trillion in incremental investment in capital expenditures, and information technology. Underpinning this U.S. reshoring thesis are structural tech advancements and a heightened focus on operational resiliency, a result of the COVID pandemic and subsequent supply chain disruption. Gone are the days when global manufacturing chased low-cost labor. Moving forward, we believe capital and proximity to the end user, parameters around which the U.S. has no equal, will dictate the regional allocation of capex, a significant positive. We view reshoring as a clear and significant positive for us industrial stocks, raising base market growth for the group while fostering a more durable stream of earnings and cash flow. At a high level, reshoring is simply shifting activity and spending into the region where U.S. industrials operate with the highest market share and premium profit margin. By our estimates, geographic mix detractors have served as a 2 percentage point headwind to multi-industry organic growth over the past 20 years. As it abates, us industrials are positioned to increase profits by 11 for every unit of global customer capex. While us outsourcing took root in the 1980s, the practice intensified when China joined the World Trade Organization, in 2000. We view that development as the primary driver of 20-plus years of us industrial stagnation. Since 2000, U.S. trade went from balance to $1 trillion in annual deficits. What's more, the U.S. lost 9 percentage points of global manufacturing market share, see chart, mostly to China, where industrial production, IP, has grown at 50 times the rate of us IP. In the past 20 years, capex shift. As manufacturing moved, so did capex. After growing at a 4 compound annual growth rate, CAGR, for decades, us manufacturing production capacity has tracked sideways after China joined the WTO. Real investment in us manufacturing grew at less than 1 per year during this period. If we exclude software to isolate the investment into hard assets that drive us industrials, real investment is tracking below the 1999 level. When compared to the U.S. annual output in the event that it had sustained the 25 global manufacturing share it commanded in the late 1990s, we estimate that annual lost output would currently be tracking at $1.05 trillion per year, or $19 trillion cumulatively since 2000. However, we view 20 global share as a more sustainable level and aspirational target moving forward, a benchmark that would imply the U.S. has lost $700 billion in annual output, or $6 trillion, cumulatively. Prior to 2000, real U.S. manufacturing investment grew at a 3.8 CAGR for 50 years versus just 0.7 since 2000, equating to about $3 trillion in underinvestment. While sustaining a near 4 investment CAGR might seem aggressive for the mature U.S. industrial economy, it only matches global manufacturing growth over the same period. Capital attraction. We are seeing early signals that the tide is beginning to turn. The pandemic served as a catalyst to accelerate the inevitable westward shift of global manufacturing. It shined a light on the true cost of outsourcing, supply chain risk. Subsequent technological advancement not only places the benefit of outsourcing, which is cheap labor, firmly in structural decline, but it also sets the stage for the next round of protectionism. Post-pandemic, the U.S. has attracted 24 of global foreign direct investment, FDI, a 900 basis point spike versus the prior decade's level, and equal to $130 billion of incremental annual investment. The U.S. is now attracting capital at a rate not seen since the 1990s, see chart. We believe Industrial Revolution 4.0 will be fought with capital and land in regions closer to enders as structural tech advancement drives improved returns and resiliency for those with an ability to invest. In many ways, this is the opposite of Industrial Revolution 3.0, and this unraveling sets the stage for a powerful, multi-decade opportunity for us manufacturing capex. While the U.S. was the loser during 3.0's search for cheap labor, we view it as the clear winner as parameters shift. The U.S. is the global leader in access to capital, accounting for 55% of global investment. The U.S. also accounts for a leading 30% of global consumption, positioning the domestic economy for supply chain localization. Undeniable momentum. The momentum in US manufacturing is undeniable. However, the key debate for investors is around the sustainability of strength as the market searches for how to appropriately capitalize current trends. We continue to see momentum in regard to durability of ongoing secular tailwinds. U.S. manufacturing continues to realize sequential gains each month. It's currently tracking at a $235 billion seasonally adjusted annual rate, up 5-fold since 2019. U.S. manufacturing construction starts is our preferred leading indicator given the long duration of these megaprojects, which can be 4 to 5 years. While US manufacturing starts are down on a year-over-year basis versus challenging comparisons, we are encouraged to see activity stabilize at about 2.5 times the pre-COVID run rate. This supports our view of a step change higher in US manufacturing investment.